welcome to this special conversation. Mirae Asset Mutual Fund and CNBC TV 18 present to you Wizards of Finance. I'm Surabhi Upadhyay. Now, over the last couple of weeks in this webinar series, we have been discussing a whole range of issues which are of absolute importance when it comes to using mutual funds as a route to look at your wealth management goals, look at long-term wealth creation. And in the series today, we are going to be talking about another very, very important topic, which actually is at the heart of any investor's wealth creation journey, the search for alpha. And to ask that very important question, whether alpha or outperformance is gradually diminishing. If yes, then what should an investor do? Let me introduce the guests on the show. Today, we have with us Vaibhav Shah, who's Head of Products and Marketing at Mirae Asset Global Investments, and Jeet, who's Head of Wealth Management at Jhaveri, Securities. Thank you very much, gentlemen, for taking out the time and for joining in this important conversation. Now, Vaibhav, let's start by making this simple. For a lot of people, the whole term itself, alpha, can be quite daunting. So let's start by explaining what it is that we're talking about here. What is this alpha, which we associate with our mutual fund investments?
So thanks, Surabhi. And like you rightly pointed out, this is one of the most important topics in the current scenario is the ability of generating alpha by the mutual fund industry. And it's a question which is very pertinent in the minds of all investors. So alpha is basically the ability of the fund to generate returns higher than the benchmark returns. And you would see that there are various categories of mutual fund schemes: large cap, mid cap, small cap, multi cap, and you have different sector themes as well. So when we take example of each of these categories, we have to say whether the fund has been able to generate higher returns than the underlying benchmark of that fund. Also, for layman investors, and SEBI is rightly told fund houses to use either Nifty or Sensex as the underlying benchmark to also compare the returns, because that's a index which investors can easily understand. So an investor would like to know how much the fund is able to generate its underlying benchmark and whether it has been also able to beat indices like Nifty 50 and Sensex.
Okay, now that's a very important opening statement. And for those who are watching, we will come back to this. What is this whole debate about your fund doing better than the underlying index? And if it cannot improve the performance over the underlying index, then should you look at a very separate category of funds? And those are passives, and we'll get to that in just a moment. But let's bring in Jeet Jhaveri into the conversation as well. Where are we in this entire progression and journey here in India?
So as Vaibhav sir mentioned, alpha is the return in excess of the benchmark, and we have been seeing that in India, the large cap funds specifically have not been able to consistently beat the benchmarks over the past couple of years, and this is something that that is a trend which is there also in the developed markets. In developed markets, lot of active funds have not been able to beat the benchmark, and people are moving towards passive funds for that matter.
Well, when I discuss this subject with a lot of fund managers or even mutual fund houses, sort of the first take that you get is don't look at absolute returns, and that's fair to a point because the market might be very high or very low in a certain phase. Look at rolling returns. So you tell us, if you've done any number crunching around this, are there actually stats that substantiate this whole theory that alpha or outperformance is actually diminishing in the Indian mutual fund landscape?
So actually, again, a very important point that you mentioned, Surabhi, is that we have to see returns not over short period of time or on an absolute basis, but over long periods of time. And what we have been observing is, let me take an example of large cap category. If you see the golden bull run we had from say 2004 to 2007, at that point we had most of the large cap funds on an average. But from 2009 to maybe 2017-18, we've seen that alpha, which was somewhere ranging between 8-10%, had narrowed down to a couple of percentage points. And 2018, I think so, was a landmark year after which a lot of things have happened. And I think so this debate of, the ability to generate alpha has also come due to few factors. One is in 2018 we had SEBI categorization, which clearly laid down what is each of the categories and where they could invest. And that made all fund houses to follow a common philosophy, which was again a very landmark decision and something which was very investor friendly. Second, we had also the adoption of TRI index, which was total return index. Earlier, funds were not considering the dividend aspect in the returns of the underlying index. And the adoption of TRI index led to about 1.5% difference, which was, of course, the dividend yield that most of the funds had. So till 2018, I think so the alpha was couple of percentage above the benchmark. But we've seen from 2018 till now, maybe most of the funds at par or maybe 1 or 2% lower. And the reason why rolling return is a very superior methodology of computing returns is because it when you take your period as long as 5 years, you make sure that the up cycles and the down cycles or bull or bear markets can also come within this period of 3 or 5 years, and you're taking longer periods of how the fund has done compared to specific periods where funds could have done better or may have not performed.
Okay, fair enough. Yeah, I take that point because I remember, I mean, this PIVA scorecard, which is basically, a scorecard that S&P indices and Dow Jones, they keep releasing on a half-yearly basis. That's been consistently showing this trend, that it's becoming harder and harder for active managers to outperform the underlying benchmark indices. But Jeet, what do you think the reason is? I mean, it's in many cases the same set of people who've been in the industry for years. So why is the outperformance diminishing, and isn't this a source of worry for investors then?
Definitely, it's a source of worry. There are a couple of reasons. As Vaibhav sir said, one of the major things that led to this underperformance has been the SEBI categorization, which is there. Post the SEBI categorization, all large cap funds have to have minimum 80% of the funds to be invested in large cap space itself. Now, earlier that was not the case. Some funds were, taking exposure in mid and small caps as well. In the large cap space as well, as India is getting more and more mature, we've been seeing more institutional participation, and the information asymmetry that the active fund managers used to have earlier is now continuously diminishing. So that is one of the major things that we see. Apart from that, what I also feel is the index itself is also to be at a fault, because our index is a free float market cap based index. Now, in this, the top weights or the top gainers have the highest weightages, and because of this, the index becomes top heavy. So, whereas in a mutual fund, certain fund managers cannot go above a certain point in terms of allocation towards a particular stock, whereas that is not the case in index, and that is one of the major reasons because the difference in the returns are coming up.
Okay, so fair point. I think those are all important factors to keep in mind. Is there any linkage between this outperformance in a bull market versus how most of the actively managed funds perform in a bear market versus their benchmark index?
So it would be an excellent point that you raised. And whenever you choose a fund, you have to choose the performance of the fund based on how it does across various market cycles, be it bull phase or bear phase. In general, what we've internally done an analysis and found out is that in the case of large cap funds and the category in general actually tends to do much better when there is a bear market phase. And that could be because when market sees difficult time like we had seen in 2008, we had periods in between 2011 to 2013 when market had seen downfall of more than 20%. So during most of these downturns, you would say that most of fund managers are able to go into defensive stocks, and their stock picking ability has helped them navigate markets much better than the index. And like maybe Jeet mentioned the point that the allocation in the index you cannot change, but as a fund house, you have that flexibility to go underweight on that stock. So that ability to go completely underweight on a stock, if you see downside, especially in the bear market, can help save investors during bear markets. Interestingly, another point that we have seen is that when markets is in a tear of a bull market, at the initial stage of the bull markets, some of the large cap funds tend to underperform because whenever market changes its cycle, it's a very difficult um, decision for most of the investors and fund managers in general, that how do they make changes in their portfolio. And you would see in market cycles there is a significant amount of sector rotation. So you would see sector rotation like we are seeing now between, say, banks, IT, metals, pharma, and the leadership keeps changing maybe every few months. Now, for a fund manager to take advantage in especially a tear of a bull market, it is not that easy for him to make that shift in the allocation, because most of the funds and the investments are made with a view of holding them for long periods of time, and hence they tend to slightly underperform when markets are in bull phase, uh, but then they start to pick up. So one point I want to just add, Surbi, is though maybe point is that 80-90% of the funds are not able to beat the benchmark, which is in general as a category. Yet we've seen that well managed large cap funds have still been able to show that ability of generating 3-5% returns higher than the benchmark.
So far, what we've learned in this conversation is one, that alpha is diminishing. Two, even then, in some of the bear market phases, actively managed funds still manage to outperform. And three, when we're in a tearing bull market, then perhaps the flexibility element, will take some time for the active manager to kick in and change his outlook on his fund selection to be in step with the newly started bull market. So, given all this, Jeet, now help us make sense of it. For a mutual fund investor, how should he align his portfolio to sort of be in tune with these realities?
So what we have internally, we have an internal grading system. When we are recommending mutual funds to our investors, we grade mutual funds on various parameters, and some of the parameters are like performance parameters, like a consistency score that we give to each fund, which is basically how consistent is the fund in terms of generating alpha. We measure that through rolling returns over different time frames, and we give them a score. We have different measures like risk parameters, a Sharpe ratio or a Jensen alpha, where we measure how much the risk the fund manager is taking to generate per unit of return. There are different other ratios like upside captures or downside captures, which measure how much upside or downside the fund is experiencing compared to the benchmark. All of these ratios are graded and given a point, and basis that we rank the mutual funds. Now, post that, we also look at specifically in large cap funds and other funds as well, what is the expense ratio these funds have, because now as we have established that a lot of large cap funds have been having a hard time difficulty in beating the benchmark. The edge over here is going to be the expense ratio, and if the expense ratio is going to be less, then that's a good part. Another
Yeah.
thing that we include would be the AMC, how standard the processes are, and how the fund managers, what the fund manager experience has been. So how is he managing other schemes that are part of his basket. So these are some of the parameters that we look at and try to understand, and basis which we recommend the schemes to the investors.
Okay. Fair enough. So lots of ratios that different planners and different sort of managers adopt, wealth managers adopt. Is there any thumb rule, Vaibhav, that one can sort of hold on to, given all the realities that we just discussed, between making your active versus passive choice? Because I'm guessing both kind of funds are required in a portfolio. So is there some guiding principle?
Yeah, so Surbi, you pointed out a very important point, that the debate is not whether it's active versus passive, it is active plus passive, and it will always be the case. So, as a blend in an investor's portfolio, you should have funds which have done exceedingly well, and some of the parameters Jeet has mentioned um, very rightly, that they should be considered while choosing an active fund. So you could have a core allocation to ETFs or low cost index funds, where you are able to participate in the performance of the underlying index, and have, on a tactical point of view, very good performing large cap schemes funds which have been showing ability to perform across bull and bear markets for long periods of time. And you have to choose funds which have done exceedingly well over 5, 7, or 10-year periods. This is very, very important because this shows the consistency of the fund house, the fund managers, and the fund house in general to navigate different market cycles and be able to deliver risk-adjusted return. So a good blend of having a core large cap ETFs and tactical large cap funds is very, very important for investors.
Fair enough. When we now talk of passives, and for viewers who might not have yet started their passive journey, very simple. These are funds that simply follow an underlying index. It could be the Nifty 50, it could be the Sensex 30. Nowadays, you have passives on a lot of other indices, including the mid cap index, for instance, including some of the sectoral indices. So the question here is, Vaibhav, whether you should only stick to the large cap part of your portfolio for passives, or whether the time has come to start looking beyond. The classic debate is that maybe a human fund manager can really identify that mid-cap gem, or should you stick to a mid-cap passive fund that will give an equal exposure or equal weighted exposure, perhaps mirroring the underlying index?
This would be a very important question that you've raised. And underlying, I would say that we've had a discussion so far on large cap funds. But when we see the case of mid and small caps, I think so we are still in that phase where a lot of the mid and small cap funds are being able to outperform the benchmark. In fact, on a rolling basis, over 3 and 5 year periods, we've seen that more than 50-60% of the mid cap funds have been able to outperform its benchmark. Uh, Unfortunately, what has happened, the alpha which used to come from a mid cap fund category as a whole, which used to be 5-6%, has narrowed down to maybe 3 or 4%, but still there is an alpha generation possible into mid caps. I think the key difference why there is still alpha generation possible in mid and small cap is, some of the points like Jeet covered, is that the research coverage is so far very restrictive to the large cap space and the large cap names. So the transparency, the research coverage makes that the information sharing for large caps has become easy. So the ability to spot the large names has become difficult. But in the small cap case and mid caps, there is still that bias where an fund manager, if he can make the right choice, can definitely outperform. In fact, in the case of small cap, we've seen maybe more than 80-90% of the small cap funds are able to outperform the benchmark. So these are trends which are showing that in the case of mid and small cap, alpha generation has started to shrink, but still their ability to generate alpha is still there. While in the case of large cap, the ability to generate alpha is now with a very few funds, which is not the case with mid and small caps.
Got it, got it. So, Jeet, is that the approach you're taking for your clients? Passives for large cap, actives for mid and small cap?
Yes, very much. We are also now changing our approach towards passive as a core portfolio, passive and smart beta portfolios. There are a lot of new interesting unique offerings which are being offered recently from the mutual fund space as well, like the factor based rule investing. So you have those momentum portfolios, or you have low volatility portfolios which are coming up, which are a combination of a passive and active portfolios, and where there is a defined rule in terms of an entry or exit in the portfolio. So there is no fund manager bias, the cost is also low. So we are looking at those and trying to inculcate that and passive portfolios in the core part of the client portfolio, and active more on the satellite portfolio.
Okay. Vaibhav, when it comes to sort of a more evolved investor, does the rule remain the same that you restrict passives to let's say the large caps where alpha is less, or would you say the time has come to start experimenting a bit more with passive funds and go beyond, let's say, Nifty 50 or Sensex 30?
Yeah, so Surabhi, I think so. What has happened, especially after the SEBI categorization, there are clear rules on what can be possible through active funds. But on the passive side, there is a lot of innovation still possible. Like Jeet mentioned, smart beta funds. You could have a lot of international investing solutions which you can make through the passive route. So I think so on the passive side, we have a lot more opportunities to explore. And that means you can create a lot more ideas on the passive side, combining factors like volatility, alpha, and other factors like momentum, which you cannot create in the normal active funds. Just one thing I wanted to add, Surbhi, is even within large cap, there is a lot of debate whether you should invest, say, in Nifty 50. There are few indices like Nifty Next 50 or Nifty 100 are also considered as large caps. Now, but when you see within large cap, Nifty 50, Nifty Next 50, and Nifty 100, all three of them have different variations. Let me give you a classic example of Nifty Next 50, which is not as well known as the Nifty 50 index. Nifty Next 50 consists of stocks which will eventually move to the Nifty 50 index, X50.
Yeah.
So what you would see is they are, an index which is from mid caps moving to the large caps. So you have a good play of emerging mid caps moving to the large cap space. You have stocks which, where the representation in the Nifty Next 50 are more in sectors like insurance, pharma, consumer, compared to say the Nifty 50, which has more weightage to financials, IT, oil and gas. So within even large caps, if you combine portfolios where you have Nifty 50 and Next 50 combined well, you can give a good blend of large cap. So what is needed is little bit out of box thinking rather than seeing whether you should have only large caps through passives. You have to see which funds in passive can be a part of large cap as well.
Yes, absolutely. Take that point. So, time for some study and homework. Jeet, so final thoughts with you. Given this fast evolving landscape, sum it all up for us. What is the advice for an investor to deal with this reality of slightly diminishing alpha, at least in the large cap space?
Yeah, so large caps are definitely seeing the alpha shrinking. So for large cap, it is definitely better to have more passive index funds and more smart beta portfolios. So what we as are what we advise to our investors is to have a core and a satellite portfolio approach, where you can have passive funds and passive index funds and a smart beta portfolios in the core part of the portfolio, and active funds like a small cap or a mid cap oriented portfolios on the satellite side. And that way you can your overall cost of the portfolio also comes down dramatically, and you can consistently get a good consistent set of returns with a lesser volatility over a longer period.
Okay. All right, gentlemen, thank you very much for enlightening us about some of these emerging trends in the mutual fund world and how investors can be on top of things and make sure that their money gets the best deserved attention. Thank you for joining in and offering all the insights. Well, that's it on this webinar. I'll see you again on the next one.
Mutual fund investments are subject to market risk. Read all scheme-related documents carefully.